My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people are my friends. Now I'm just trying to make sense of it here because I want to make you some money. My job is to entertain, to educate, teach, and put this whole thing in context. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Now, if you listen to the bears, right, we're in the grip of what? Yes, persistent, pernicious inflation that is certain to wreck the economy as well as your pension, your payroll, anything. And don't even get me started on the budget deficit. They know nothing! Yet there's a conundrum here. The averages are holding up pretty darn well, aren't they? Dow dipping just 6 points today after making a new high yesterday. S&P advancing 0.30% and hitting a new intraday high. And NASDAQ gaining 0.62%. All right, so despite what you hear from the commentators, this market's endless advance keeps posing a powerful question, doesn't it? What happens if it turns out that the move is justified by the fundamentals, as opposed to what everybody comes on and says, which is not justified, not just. What happens if it's justified? What happens if the woes that plague the economy are easing? What if things are getting better? Well, I suspect we're overbought. I know that from my S&P oscillator I follow, and we could always have another leg down. I think there could be any buying opportunity that you should pounce on. Remember, 7 to 10 days from now begins the most seasonally strong period of the year for the last 23 years. So I would hold on to stocks or pounce on weakness, as we are doing for our new investment club, which, given our ubiquitous QR code, is pretty darn easy to sign up. A QR code is that thing that looks like this. Is that good? I mean, doesn't it look like? To me, it does. I mean, I hold my camera up the wrong way to it, so, you know, get a little lesson there. All right, let's synthesize what we've been hearing from the CEOs of major companies, since I'm on every earnings call. There it is. See? I'm on every single earnings call, and my life is terrible, and I'm driving my wife crazy. Here we go. Here's some clues that I'm getting that you're not hearing, because people are looking at that top-down stuff doesn't have the real deal. Why don't we start with the bank CEOs? Given where we were 20 months ago, the American consumer is now in remarkable shape. Individual balance sheets have gotten so strong that people don't need as many loans. By the way, it's the best balance sheets in the history of our country, okay? And when they do need money, their credit scores are absurdly high. What does that mean? It means they can borrow money and create a small business. And there's an astounding resurgence in small business, which gives banks the opportunity to turn a profit by lending people money in a prudent way. There's no spike up in delinquencies, spike down. Having studied the banks for the last 40 years, I can tell you these institutions are indeed in the best shape I've ever seen them. When the banking system's strong, that's very good news for the economy. Second group, the transports. Boy, have you seen the transports? Have you been following the action there? My most favorite group to look at. For example, if you listen to this morning's conference call from Union Pacific, Lance Fritz, we had him on not that long ago. He was kind of bearish. Remember, I was trying to get him to be positive? You know that the port situation has been improving ever since President Biden got involved with his 24/7 plan to ease the congestion. And that's a big reason why Union Pacific, a very big position, by the way, of my charitable trust, that you can follow by joining the investment club, rallied to an all-time high today. When it comes to fixing the supply chain, I think there's a surprising amount of low-hanging fruit. You know what I'm telling you? That problem is a lot less intractable than many people seem to assume. Just got to shine a light on it. Third, this earnings season is where we separate the wheat from the chaff. The truly great companies like Procter & Gamble, they can cope with higher costs by raising prices in order to pass them on to the consumer. They haven't even done yet, and they've got 4% growth. Can you imagine what their quarter's going to be like next time? Meanwhile, Costco, Home Depot, Walmart, Amazon, and Lowe's have used their massive scale to keep prices relatively contained, tamping down on inflation where they can. They've done a good job. It's not perfect, but the outsized pain from higher prices seems to be weighing, at least on the margin, even as inflation is certainly upon us. Some companies have pricing power, others don't. The ones with pricing power give you great stocks. The ones without pricing power give you great bargains on their products. Fourth, more than a handful of chartists I've been studying have told us that oil would peak at or below $84. That's been that line in the sand for us. On the fundamental side, well, it seems clear, unless we're heading to another ice age, we have enough natural gas to keep energy prices from skyrocketing. So what happens to the stock market if oil and gas start coming down, which is, like, have you ever heard anyone even say that? It would be a positive. On the oil side, the United States is still a long way from producing what we did before the pandemic. But do you know that the Permian Basin is no longer falling behind? The private producers are gearing up aggressively. I think it's only a matter of time before we see the same story in the rest of the country. I did not feel that way, but I'm seeing Permian going up. See, our producers are sitting on so much product, they could make fortunes at these levels. They're not going to leave it in the ground, even as their discipline to date has been integral to the price rise of crude. That's a new development. There's one exception here. The Northeast won't get any break on energy prices. That has more to do with the lack of pipeline capacity because people don't want pipelines under their land. Fifth, let's talk chemicals. This morning, Dow Chemical, a company I like very much, reported a terrific set of numbers that indicated supply is still very tight, pricing going up. I've been worried that the two key building blocks, which are polyethylene and polyurethane, might tip into equilibrium and then oversupply because new capacity is being added. But that sure isn't the case right now. I thought Wall Street would like the quarter. Nope, the stock got hit. The stock told you capacity is coming. At the same time, PPG, the coatings company that's a big consumer of commodity chemicals, reported what I thought was a pretty negative number. It said raw costs remain a persistent bad problem. And what happens? PPG rallies nearly 3%. Now, you don't need to be a rocket scientist or a chemist to figure out that the market is speaking here, and it's calling a top in these key commodity chemicals. The market sees lots of new plants coming online, and that means prices should come back down in 2022. Now, most of the commentators who've read about inflation are these big picture people. They look at giant aggregate numbers, usually the government statistics. They're allergic to the kind of granularity that I bring to you. I eat granularity for breakfast, and breakfast tastes bad for the chemical industry. Tastes like those lousy rice cakes I eat. It's good for the rest of us, though. How about steel? You know I like Nucor, the biggest and best steel maker, but there are many bears who've been prowling around Nucor and its steel compadres, arguing that they've seen peak in pricing. We're going to talk about that later with Whirlpool. Nucor did miss estimates, and those estimates were set not that long ago. And that gave the bears the evidence they needed to call a top, and it's why the stock got slammed. We told club members we don't think that. We think it's an opportunity. But I see when people say that the steel cycle has run its course when Nucor misses its numbers. So let's see. Let's say there is a peak in chemicals. I think there may be. Let's say there is a peak in steel. I don't think so, but you know what? The market says I'm wrong. All right, one more. That's the biggest of all, the semiconductor shortage. Total horror show, right? How have the basic semis been doing? Micron's cascading lower. Meanwhile, you listen to the semiconductor capital equipment makers, as I did on their comm calls. Sure doesn't sound like the shortage is going to last forever. Neither Lam Research nor ASML gave you a sense that business is on fire. I was surprised at that. In fact, Lam embraced the midpoint of pretty much every range of estimates. I was hoping to come to you and tell you to buy that one. So when you hear people predicting that the chip shortage should last well into 2023, ask yourselves, then why the chip makers aren't buying new equipment like crazy to take advantage of that? I get the feeling that there's been a lot of double ordering in the system all the way down the food chain. And that's why the capital expenditures aren't going off the charts. The industry seems to expect that there's a surfeit of semiconductors coming all over the place, not just in the cheapest commodity chips like DRAMs or flash. Those are Micron's bailiwick. Yet the price increases are either becoming baked in or they're not coming through at all. So again, like I did with, because I'm trying to always teach here. Like I said with Dow, commodity going into PPG, let's look at it another way. Look at through Ford Motor. Now, you might be wondering, how could Ford Motor see its stock rally 3% today, only $2 from where it was 10 years ago, even though it's a huge buyer of all the commodities I mentioned and totally hostage to the chip shortage? I think the rally in Ford stock says the tyranny of the supply chain may be coming to an end, even as I told members of the investment club to be careful because it's been up big on 2 straight days. All that said, there's one inflationary item I don't have an answer for, and that's the labor shortage. We're beginning to see more people return to the workforce with these vaccine requirements, but the profound loss of 700,000 people in our great country, coupled with the victims of long COVID and the remaining unvaccinated, give you plenty of reasons not to go back to office. Fear. Fear. At the same time, there's this widespread reassessment of life itself. You know what? I'm willing to get existential. You know why? Because we had the same thing happen after the Civil War, after World War I, and World War II, where we had major labor shortages and a lot of plain old partying. It's happening again as the war on COVID winds down. People are trying to figure out what to do with their lives. They will figure it out, and when they do, I think things will end fine, the way they did in the 1950s. Of course, not all deflation is good deflation. Look at Snap, down more than 20% in after-hours trading because Apple's new privacy rules make their targeted advertising a lot less precise, therefore less valuable. You want deflation? And talk to the owners of Snap. However, with the exception of labor, there are suddenly a lot of bullish pieces in the inflation puzzle that I see that I want you to see. If you wait for these prices to finally come down, if you wait for the jigsaw puzzle to be completely finished, you'll end up waiting too long. Let me give you the bottom line. Jumping the gun is a mistake in almost every single human endeavor, except for the stock market. The averages have been gun jumping on peak inflation for the last 10 days because the big guys cannot afford to wait to get in. Soon, neither can you.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.